The manipulation of any financial benchmark or a product used to determine a benchmark is now a criminal and civil offence and subject to penalties. For individuals, the maximum penalty is up to $945,000 and or 10 years imprisonment, and for a body corporate, the maximum penalty is up to $9.45 million. The laws will better protect Australians from the possible abuse of financial markets by sophisticated financial institutions, Federal Treasurer Scott Morrison stated. He added that these penalties can be used against foreign nationals and bodies corporate even when the conduct occurs abroad, provided it results in an Australian entity suffering a financial loss or other disadvantage. As long as there is no intent, legitimate business activity that has the effect of moving the benchmark is not considered an offence. Purchasers of new residential premises and or subdivisions will be required to withhold the GST on the settled purchase price and pay it directly to the ATO. The new law comes into effect from 1 July 2018 and is designed to stop illegal Phoenix activity in property development. Illegal Phoenix activity is when a new company is created to continue the business of a company that was intentionally liquidated by the directors to avoid paying debts, including tax. Minister for Revenue and Financial Services, Kelly O'Dwyer, said the measure will put an end to the problem of some developers collecting GST on their new properties but then dissolving their business to avoid remitting the tax when it is owed to the ATO. The US Federal Reserve has raised the target range for the federal funds rate to between 1.5 and 1.75%. This is the first time in 18 years that the Fed's interest rate has been above the RBA's cash rate. The central bank for the world's largest economy signalled that it would continue to hike interest rates as it expected economic activity to expand at a moderate pace in the medium term, with labour conditions remaining strong. The projected median growth in real GDP for 2018 was revised upwards to 2.7%, compared with a projection of 2.5% in December 2017. The projection for personal consumption expenditure inflation remained consistent at 1.9%, a little bit below the Fed's stated 2% target. The bank has also continued its policy of quantitative tightening, steadily returning its balance sheets towards normal. Years of quantitative easing led to total assets exceeding US $4.5 trillion. Quantitative tightening works by slowing down the reinvestment in maturing bonds and mortgage-backed securities. The Financial Advisors Standards and Ethics Authority, or FASEA's Chief Executive Dean Sanders has resigned. Board member Dr. Mark Brimble has been appointed as Managing Director while a search for a permanent Chief Executive is underway. Brimble commenced as Acting Managing Director on the 23rd of April 2018 and will remain in the role until after the 31st of July 2018. Sanders was appointed as the inaugural Chief Executive of FASEA in August 2017. Some financial advisors, associations and corners of the media have had a strong reaction to the establishment of a body tasked, under legislation, with professionalising the industry and query whether FASEA's approach is the best one. The Parliamentary Joint Committee on Corporation and Financial Services' final report on the life insurance industry has lambasted the sector and made numerous unanimous recommendations for reforms. These recommendations include, but are not limited to, aligning consumer protection for financial products with Australian consumer law, in particular removing life insurance exemptions, extending the banking executive accountability regime to the life insurance industry, a consolidated industry code of practice enforced by ASIC, limited access to consumers' full medical records, regulating the sector's use of genetic testing, and further life insurance inquiries, including into payments and benefits, approved product lists, and compliance with the Superannuation Industry Supervision Act 1993. Unlike some other reports into financial services, this report has support cross-political parties, reflected in the unanimous nature of the recommendations by the Parliamentary Joint Committee. Industry associations were less accepting of the findings, with the Financial Services Council, Australian Institute of Superannuation Trustees, and the Association of Superannuation Funds of Australia, all claiming that many of the recommendations had been addressed by the Insurance and Superannuation Voluntary Code of Practice. However, each acknowledged that some of the recommendations were desirable and needed. Australia's anti-money laundering and counter-terrorism financing regulator has been granted new legal powers to regulate cryptocurrency providers. Digital currency exchange providers, or DCEs, operating in Australia, including Bitcoin, must now register with AUSTRAC and meet anti-money laundering and counter-terrorism financing compliance and reporting obligations. AUSTRAC CEO Nicole Rose said the new laws will strengthen the agency's compliance and intelligence capabilities to help DCEs implement systems and controls to minimise the risk of criminals using them for money laundering, terrorism financing and cybercrime. Large financial institutions have considerable room for improvement in the design and implementation of executive remuneration structures, according to an APRA review into industry practices. The detailed analysis examined whether practices at 12 regulated, authorised deposit-taking institutions met the prudential objective to encourage behaviour that supports risk management frameworks and institutions' long-term financial soundness. The report found a lack of consistency and that practices fell short of APRA's existing better practices guidelines. The report identified the need for improvement in ensuring practices were adopted that were appropriate to the institution's size, complexity and risk profile, the extent to which risk outcomes were assessed and weighted within performance scorecards, enforcement of accountability mechanisms in response to poor risk outcomes, and evidence of the rationale for remuneration decisions. The regulator is now considering ways to improve the prudential framework, taking into account the BEAR regime and international best practice.